Welcome to 8020 Property Management's TV channel, a resource for property investors to enhance their property investment returns and property management experience. With the end of financial year quickly approaching, it's time to talk tax. And in this particular episode, we're going to focus on one of those tax-deductible items often overlooked by property investors, their financial planner and accountant, and that is depreciation. Research shows that 80% of property investors are failing to take advantage of property depreciation and are missing out on thousands of dollars in their pockets. So, what is depreciation? As a building gets older, items wear out. They depreciate. The Australian Taxation Office allows property owners to claim their depreciation as a deduction, as long as they are receiving income from their property. You do not need to be spending additional money for it to be claimed because it's already inherent in the existing building structure, fittings and fixtures. So let's take a simple example of a standard house and land package with an approximate construction cost of around $350,000. Owners of that new investment property can claim capital works at a rate of 2.5% over 40 years from construction completion. That represents deductions of between $8,000 and $10,000 in the first year alone. Various items of plant and equipment such as the oven, cooktop, range hood, dishwashers are eligible to be depreciated at various rates depending upon their effective lives determined by the Australian Taxation Office. In this example, that represents deductions of between $9,000 and $10,000 in the first year. Cumulative deductions over a 5-year period can be as much as $70,000 to $95,000. These deductions reduce your taxable income, allowing you to pay less tax and increase the cash flow from your investment property. To maximise your return, owners of investment properties should contact a specialist quantity surveyor to prepare their depreciation schedule. Your accountant, financial planner, real estate agent cannot do this as they are not recognised by the ATO as licensed providers of that advice. So some quick tips to consider. Keep in mind you can amend previous year's tax returns up to 3 years to recoup any unclaimed or missed depreciation benefits. To claim depreciation, it does not need to be a new property. Properties built after the 16th of September 1987 are eligible for deductible depreciation. And if you are carrying out any minor or major refurbishments like a new kitchen, may be eligible for capital depreciation. So keep all receipts for inclusion in your depreciation schedule. And having a professional depreciation schedule can also enhance your selling proposition upon disposal if you can demonstrate some inherent benefit for the buyer. There are a myriad of educational webinars, videos, tax depreciation calculators, but it's not my intention to reinvent the wheel. So I've included some useful links on my website that can direct you to some of those. I'm also happy to refer you to a select group of professionals that can assist you in these matters. Simply contact me direct by phone or email for details. Claiming all the depreciation you are entitled to on an investment property can make a big difference to your cash flow, putting money in your pockets and not that of the tax office. I trust this information has been of benefit, and I look forward to our next episode on 8020 Property Management TV channel. Bye for now.